Lots of ducks out there for you, Leo. Hey, hi. Welcome back to You Heard From the CFP. Leo and I are here in Excelsior, Minnesota, my hometown. Well, we're looking at ducks, but we're also here to talk about why long-term investors always win. Let's dive in. Leo, busy. All right, well, we love doing dog training by Lake Minnetonka. So if you're curious where that video was shot, in an area called of Excelsior, right next to Lake Minnetonka. Lake Minnetonka is a big lake to the western side of Minneapolis where I live. It's about a mile away. So that video was shot there, and we had a nice fun time. Leo has since abandoned me. He is sleeping at my feet. He refuses to participate in this video any longer. I think he's on strike, so we'll just leave him be. Today is November 9th, 2021. Welcome back. Thanks for coming back to You Heard From the CFP. My name is Matthew Coyle, and today we're going to talk about a couple charts that popped out to me this past week online that I thought I would just flush out a bit, and these always make kind of interesting videos. So what I did was I pulled these charts here, and I'll put them on the screen. The first chart is new investors in the year 2020. Of all new investment accounts opened in the year 2020, over 60% of them were opened by folks between the ages of 18 and 44. Now that's majority millennials. And what's interesting is that just very much juxtaposes with where we are right now. And I'll put this other chart on the screen, if I can get it here. Wealth by generation. So I saw this one floating around Twitter, I think it was, and unsurprisingly, I think we all know that baby boomers control the majority of the wealth in the country. That by itself is not very surprising, and not that insightful, frankly, but millennials, of course, being a distant fourth on that list. But the question remains, will these new investors learn the lessons of their baby boomer counterparts or their Gen X counterparts and keep their money in the market for the long term, or are we raising a generation or have a generation here of short-term traders? And if you are thinking about short-term trading, what can we do to convince you that long-term investing will always win out and always win the day? And the only way to do that is with facts. So I'm going to show you some facts about long-term investing. I think you might find interesting. How often is the market up? How often is the market down? Let's take a look, because I think you might find the data very insightful and very helpful. Well, I often lament the fact that as a financial advisor, it can be tough to get people to focus on long-term investing when the market is so good and has been so good for the last decade. We've had a heck of a good decade in the stock market. We really have. And now with a lot of short-term traders coming into the marketplace with crypto and small cap stocks and micro cap stocks and quick money being made, sometimes it's very difficult to just come back from 20,000 feet up and say, why am I a long-term investor? What are my odds of success? So I'm going to show you some data points that I found very interesting this week. This has been floating around as well, and I thought, why not put it up here? Because if you know someone who's a short-term trader, or say you have a young person, maybe in your house, who you're trying to get started investing, a child or nephew, or maybe, who knows, whatever. Maybe you'd like to get them investing, but you need to show them something. You know, why would I be a long-term investor? Why not just go for the quick hit money? The reason you would is because of the facts I'm about to show you right now, and I'll put them on the screen. Well, it's well known that persistence pays off, and investing is no different. So what we'll do to illustrate this is we're going to take a time period from 1926 to 2021. That's a very long time period, and what we'll do is we'll break it up into randomly chosen 1, 3, and 5-year time horizons. So putting it simply, if you had chosen a totally random 1-year time horizon, a totally random 3-year, and a totally random 5-year, what are your odds of success in just simply buying 100% stock S&P 500? Here are the odds. I'll put them up on the screen. If you are an investor for 1 year, hi Leo, 1 year in a S&P 500 index fund, he likes to look outside. 1 year in the S&P 500 index, almost 76% odds of being positive over 1 year random chosen time frame. 3 years it jumps to 84%, and 5 years it jumps to 88%. So your odds of being successful just by buying the S&P 500 and just being more focused on indexed investing with a randomly chosen time frame, you have done better than most short-term traders. Hi, buddy. Let's change the time frame, or the portfolio mix to a 50-50 S&P 500 and 10-year bond, government bond portfolio. So 50-50, what are your odds at that? Over 1 year, your odds jump to 82% of being positive after your initial balance. Your 3-year randomly chosen is 93%, and your 5-year randomly chosen is 96%. So simply by investing your money in a long-term portfolio designed for the long term, even over randomly chosen time periods, you do better than most traders would, because most short-term traders simply trade their accounts until they blow up or they take too much risk and then they're out of the market. So if you stay focused on the long term, you'll be better off, and the odds definitely reinforce that. So what if you're a short-term trader? Now, as someone who came into the business in the late 90s, and kind of my career kind of got going in the early 2000s, I've seen a lot of day traders. This was the back at the kind of tail end of the dot-com era. A lot of people trading. Some people did well. Most are not even doing it anymore. In fact, only about 7% of all day traders actually continue on beyond like 5 years in the business if they're day trading. About 90% of all people who day trade either completely break even or lose money. The other 10% make some kind of money, although it's rare that people make a living at it. For short-term traders, it's very, very difficult to beat the market for a number of reasons. Emotional attachment to what they own, sentiment-driven trades, which they don't really understand, lack of fundamental analysis of what they're actually buying and selling, or just making bad bets and taking too large a bets, which eventually turn against them and their whole account blows up and they can no longer sustain the capital requirements to be a day trader, and they have to quit the business. So if you're a short-term investor, your odds of success are about 10% versus your odds of being successful in 1 year with a long-term design portfolio are about 75% odds of success. I know where I would put my money. If you're a short-term trader, I would encourage you to be focused on the long-term and just leave the short-term stuff as noise and be focused on what you want to be doing long-term and why you're doing it to begin with. So I hope that data was helpful. I thought that kind of thing was interesting. I thought it was a good thing to flush out. I hope you're having a very nice week, and thanks again for watching, and I will see you next time. Take care.